All right, it is officially 2 o'clock. So if you're a straggler, you're going to have to get notes from somebody else in the class. And if you're not a straggler, welcome. Um, I guess I should probably start with a bit of an introduction, which is, and actually, I'll start by unsharing the screen. Now you can see us in full. Welcome. If in the event that you do not know who we are, or at least one of us is, my name is Matt Pohlman. I'm the founder of East Franklin Capital, and we are, I'd say, we're an independent investment firm. I guess in today's world we might be called boutique. Right? I think we're boutique. I think we are, and we do investment management and advisory work. And so my background obviously is in that. I've been doing that for quite a while. I was at a firm prior to starting East Franklin Capital, Franklin Street Partners. Prior to that, I worked for a larger investment firm. Worked for Ernst & Young for a while. A master's in accounting. Actually, I'm a CPA.
You have a lot of jobs.
So there are two CPAs on this call. There are two. Well, actually, maybe more. Maybe there are other CPAs joining us. But I do. I was all conference in high school in basketball also. How's that?
Do you want me to share any fun tidbits about you?
No, I don't. No? But I feel, but you need, everybody needs some background. So, investment management for 20 plus years is probably the most relevant piece of information. And so, but more relevant, more important to all of us, most of us, I should say. I should probably introduce Shelby. I should note that we looked long and hard for an expert, and what we got was Shelby. So you can't. She has actually. Can I try to introduce you?
Sure.
Shelby Pohlman is a CPA. She is a CPA. Yeah. She taught accounting for quite a while at the University of North Carolina, Chapel Hill, in the Masters of Accounting program that we both graduated from. Specifically tax. Worked for BDO Seidman, which is an international accounting firm in both Charlotte and Seattle. Worked for one of the co-founders of Microsoft. I'll let you figure out which one of those two it is. There's only two of them, and it's not Bill Gates. And you did tax work for him, so that'd be categorized, I think, as high net worth tax work.
Yeah, I think he was the second or third richest man in the world when I worked for him.
Yeah. Any other relevant piece of information I've left out? I mean, I think
after Paul Allen, I went back to public accounting in a smaller firm in Chapel Hill, and then in 2007, after my youngest kid was born, because I didn't have enough to do when he was 6 months old, I started my own CPA firm and have run it ever since.
You're a deadbeat husband.
I had to do it all.
Somebody had to earn in our house. Actually, maybe I should state for the record that we are in fact married. Currently. All right. So those are the introductions, and so I'll to some extent kind of dive in. Obviously, Shelby. Really, this is actually nope. I'm sorry. I need to do a disclaimer. Let me disclaim first that everything you're about to hear has been made up. No, this is a slide that everybody should read. I want my chief compliance officer to be aware that we've done this. Shelby probably does too. I assume this says something along the lines of our opinions are our own.
Correct. There's
no question that my opinions are my own. I may even say something I regret saying. Who knows? Who knows? But these are our disclosures. So that's an important component. This is our lead slide. But Shelby, I'm going to dive into kind of your piece because it does. I mean, this webinar is about the OBBBA, One Beautiful Bill Act.
Big Beautiful Bill Act.
Big Beautiful Bill Act, and the tax implications. I know that there are lots of tax implications. Which I mean, you and I both thought it'd be helpful to cover some of the highlights on the individual front. We are not likely to touch on much on the corporate and estate side. And we'll probably sprinkle a little bit in, even if just accidentally. But so I'll pull up your slide and let you take the reins.
Okay.
But I think that's probably the best way to tee it up.
Okay. Great. Thank you, Matt. That was so sweet. Um, I know we're here to talk about the One Big Beautiful Bill Act, which I will probably call OBBBA from here on out, and miss a B here and there because there's so many. But I think it's important to kind of jump back a little bit to 2017 when the Tax Cuts and Jobs Act, which I will call TCJA, came into being. So Trump's first term, you guys remember that bill came through. Essentially, what most of us remember about it is there was this big promise to make everything simpler. And we're going to be able to do our tax return on a postcard. I don't know if anybody remembers that. That has not happened as of yet. But there was some real push to simplify preparing your taxes. And one of those things, and I think it actually was successful on two fronts. One was it implemented a very large standard deduction. So that took like 30% of people who usually itemized, and they didn't have to really itemize anymore. So that is simpler, right? Taking a standard deduction rather than keeping track of, medical and charitable and all these expenses. So I think it was successful on that front. The other thing it did to simplify taxes for individuals, and I'm talking individuals here, is it made the AMT exemption higher, made the phase outs bigger. So tons of people that had been under the alternative minimum tax were not anymore, which, trust me, will simplify a tax return pretty quickly. So I thought it did a really good job with those things. It in my opinion, again, opinion disclaimer, it added a huge new layer of complexity with the 199A section, which is the qualified business income deduction, which was trying to create some parity between driving the corporate tax rate and people that had flow through entities, kind of giving some parity on a rate. So that's where we started. So why the One Big Beautiful Bill Act? So the 2017 Tax Cuts and Jobs Act, most of the provisions were going to expire at the end of this year. So had that happened, then we would have gone back to the tax environment in 2016. And I would say there's some things in that bill that people have gotten used to, namely the lower individual tax rates and the expanded standard deduction. So the looming expiration of that and those provision setting was part of the driver of this bill. Trump also made campaign promises that he wanted to implement. You guys will remember them: no tax on tips, no tax on overtime, no tax on Social Security. So this bill was supposed to incorporate some of those campaign promises. And then, on top of all that, there's some spending changes related to defense and homeland security. Questions, Matt? Are you good? You following along?
Some.
Are you keeping pace?
Some. It's like 1,000 pages. I mean, there's yeah. Spending and policy has definitely had some.
Yeah.
No, it seems right. Seems right.
So there's some pros in the bill, and this is probably agreed upon by most. I would say I'm not, stepping out on some limb here. The pros would be some pro-growth provisions, which are much more on the kind of business corporate side. So I'm not really going to get into them, but they made 100% bonus depreciation permanent for short-lived assets. Domestic research and development expensing was made permanent. So a lot of good business provisions that are supposed to fuel some pro-growth. The other thing that I think it did, which I think is a real pro, is it gave some stability, right? So we've been under these rates and some of these rules, and we're going to talk about them in a little more detail. But a lot of the provisions that were set to expire, the OBBBA made them permanent. And it just gave stability to taxpayers for another, let's say, I think most of them are good through 2029. So I think that's good. You
briefly? Yes. Yeah, and that's I would argue at least that's the beginning of where there may be market implications for the impact of the OBBBA, right? Which is, there is a general. I don't know if it's a law of nature, but I think generally speaking that markets prefer information, right? And lack of information is a problem, and so now we have, at least for now, I know a lot of the descriptions you read online or hear about are about permanent tax changes. Well,
right.
I think it's obvious that nothing's permanent because you can make a bill, you can enact a bill that changes previous bills, right? But for now and for arguably this foreseeable future, I think we do have some, and I mean, if not certainty, some stability as you described.
Yeah, and I'd say, we think of permanence in our life different than people think of permanence in a tax bill. Permanence just means there's no provision so that it's going to sunset. That doesn't mean that some other administration is not going to come in and change something. But permanence means this is here for now, and there's not some clock or at some point in the future that these are all going to revert back. So the OBBBA took a lot of temporary provisions that were set to expire this year and made them, I'm going to say, quote unquote, permanent.
Right. Fair enough.
So stability. So cons. Okay, here are the cons. There's a lot of new carve-outs. The no tax on tips again, the no tax on overtime. Okay, auto interest loan, the additional senior deduction. They're kind of some people say gimmicky, but I just like to say new carve-outs. They kind of across the board can sometimes violate like the fairness principle or treat taxpayers equally principle. So because it's making the code a lot more complex. And when you make the code complex, the people that it's there to help sometimes don't have the resources to take the fullest benefit of those. So that's sometimes a concern. There's a potential narrowing of the base. And what I mean by that is, Matt, you got to think back to like our first tax class together at UNC. Can you go back that far?
I don't want to out your age, but
I'm not putting a year on it.
Was it Teddy or was it Teddy or Franklin? Which Roosevelt had just, I don't remember. It's been a while.
So total tax revenue is a function of, I'm going to call it big T, right? Big capital T is a function of the base times the rate. All right, what do I mean by that? So in individual tax world, your base is your taxable income. Right. So taxable income is what's your income? What are all the things you have to show as income? What are your deductions? Are you taking the standard deduction, the itemized deduction, and you kind of net all that out and you get to your base, your taxable income number. You take that number and you times it by your rates. In our case, a progressive rate system. So you go through the varying levels of the rates until you get to your level. So when you narrow the base, what that means is you've added more deductions or you've changed what's called income. But in this case, we're going to talk about like the auto loan interest deduction, right? So that's a new deduction. And if someone's going to take that into account, what you've done is you naturally reduce their base. And in a static environment, what people worry about is if your R is staying constant, which it is because they locked in the rates, but your B is getting smaller because you're giving people all these new deductions and or changing what used to be taxed as income. It's no longer taxed as income, like the no tax on tips. Then you're going to naturally bring down total revenues. And I think in this case, at least this administration feels like this is opinion, that's going to be offset by growth, the tariffs, and some other more market. So I don't know if you want to jump in here, but some more market considerations.
Right. Well, I mean, the example that you use, the deduction for a purchase of a vehicle, right? You get a deduction. Right? I mean, that is, and you could certainly make an argument that will incentivize more vehicle purchasing. More vehicle purchasing will be positive for a variety of industries, et cetera. Right. So I mean, there is I mean, at least you could argue there is a direct. I mean, one of the things that's come out of this bill, right, is like some of the green energy credits or the say solar, but there's some green energy credits are going away, and so the reverse could also happen, right? But those both impact the base, right? Those both impact, and my argument on the market side is they impact behavior, and the behavior impacts or has impact on the markets. I mean, just consumer spending in general. And this is to your point. I think their idea is you can kind of grow the base, right, through just growth, economic growth.
Is what people that are proponents of this bill, that's exactly what they would say.
Yeah.
That you may, like, I think they projected that they being the tax foundation, like based on the 2025 changes alone, it was going to cause an annual, like a $67 billion deficit. Don't quote me on that, you guys, but it's some number like that. But they're like, that's not a concern to them because they feel like that will be made up in so much more in these other areas by expanding the base and other sections. Like I'm just talking individual. So in your scenario, the individual base would drop. But if someone goes out and buys a car that they normally would not have bought, because now they have a deduction for it, then that just increased the base and the income of the car dealer.
Yeah.
Okay.
Yeah.
Okay. Sorry, I stayed on that a little longer than you probably wanted, but
I mean, car discussion is so fascinating.
So
I mean, base tax
Put
rates.
Me on my next slide,
whatever.
please.
Frankly, I wasn't even paying attention.
I know you weren't. I know. That's
all right. Let's go to our next slide. What'd you say? Something? All right. Next slide. Sorry.
Yeah, so now I just want to look at the bill and some specifically individual provisions, just kind of at a glance. So we're not going to stay on anyone, super long, but we're going to hit like the itemized section pretty well. But so some things that got permanently extended. So the tax brackets you've gotten to know and love, they're not going anywhere, right? So had this not come into place, then the top two brackets would have jumped back up. I will say this is not like an advocating for or against, but I will say from an absolute professional standpoint, when I went from 2016 to 2017 or whichever tax year that TCJA came into effect, across the board, top to bottom, my taxpayers all effectively had a reduced tax rate. And I think people have gotten used to those rates. And so permanently extending them, again, provides that stability to the tax landscape. And I think markets probably like that. There's a permanent extension, again, permanent meaning it's not got a sunset provision of the standard deduction. So it's locked in now, and it's adjusted annually for inflation, but they're not big jumps, but there are going to be little movements every year. The personal exemptions, you guys have probably already forgotten about them. They were taken out of the tax code in 2017. They are not coming back. I would venture to say we will never see them again. That's right. I said it. Put me on record.
It's quite a statement. And just for those,
exemptions are gone.
Yeah.
And the alternative
breaking
tax
news.
Exemptions. Breaking news. Yeah. Put me on some news.
Do you believe AMT is going away?
So it was so wildly unpopular before. So AMT, a little background, it came into play a long time ago because they felt like really wealthy taxpayers were taking advantage of loopholes. So what the AMT was supposed to do is kind of close those off. And it was this parallel tax system that if you were kind of finding these little loopholes, they could kind of grab you and pull you back in and get taxed that way. It had a maximum tax rate of 28%. It was a two-tier tax system, 26, 28. What happened over time is they never adjusted the exemptions. The exemption's kind of like the AMT world of a standard deduction. It never really grew. So over time, it kept pulling more and more people in, and it became this huge nightmare for just middle income taxpayers. So possibly, but it's like, It's like going back to the old estate rules. It would be so politically wildly unpopular. I don't think it could ever happen.
Yep, fair enough.
Going out on a limb here.
Yeah, no, but I mean, whether it goes away entirely or not, the point is these are provisions that have shifted, and now they've shifted already one time, and they're now shifting further down to potentially going away.
I had almost all my taxpayers in AMT. I now have almost nobody in AMT.
Right. So we've already seen a major shift. Yeah.
We've already seen a major shift.
Yep.
So I want to go back to the whole standard deduction, itemized deduction. So
I thought we were past this.
I know. I'm sorry. I know. Just settle in. You're gonna be here for a while. Okay. Everyone's favorite, the SALT deduction. All right. People lost it, right? When the one thing in the Tax Cut and Jobs Act that really just got a lot of attention is you used to be able to deduct your state and local income taxes plus your real estate taxes plus your auto taxes, total amount, whatever it was, that was your itemized deduction. Great. For some people, that's a big number, right? Think about your income taxes you pay to the state and your real estate taxes. Just in your own mind, if you're out there listening to me, like total that number up. And they put a cap on it at 10,000. And most of us go well over that 10,000. So that was not popular. The question was, in this bill, you got to change it. How do you change it? Where do you land? So people didn't want to go back to the unlimited number. So where they landed is they've increased the cap at least starting in 2025, which is also unusual for them to pass a law in a year and then change something for that year. And they do that like 2 or 3 times in this bill, at least on the individual side. But
so this is effective. This increased salt is effective for this tax year. When we're in that,
correct? 2025. Yep. Thanks. And make a note. This year, not next. The cap is increased to 40,000. Okay. Why is that kind of a big deal? Okay, you get more of your tax deduction. It also is going to pull a lot of people back into itemizing. Because before, example, you've got a taxpayer, they don't have any high medical, they own their house, so their only itemized deductions are their charitable donations and their state and local taxes. If your state and local taxes are capped at 10,000 and you're married filing joint, your standard deductions, let's just use 30,000 because that's close enough. You've got to have a lot of charitable to bridge that gap, or you're just going to take the standard deduction and move on with your life. If suddenly the cap is back to 40, with your state and local, you might almost get to the standard deduction, if not over it, right? Depending on where you live, how much you pay in income taxes. So I think it's going to start pulling a lot of people back into itemizing,
right?
Which just increases complexity. It doesn't bother me. Which is good for me.
Pohlman family winner. No, I'm kidding. But actually, I'm not kidding. It really is going to impact. I mean, if an itemized deduction is obviously more. There's more to it. You got to confirm all the moving parts of.
Well, they have to track it, right? Medical. So people have forgotten about it. They're like, people don't even look at their medical anymore. They don't give me any. And so now they're going to like, oh man, now I got to actually pay attention to what I'm paying and summarize it and give it to Shelby or whoever. So. Right. So it's a 40,000 cap.
Shoebox receipts. Receipts.
Oh no. If you're a client of mine, please do not ever hand me a shoebox.
Do it.
It's 40,000 now, but here's the caveat. It's 40,000 through 2025 through 2029. This does have a sunsetting provision. If nothing is done, this will sunset in 2030. It'll go back to the 10,000. So that's the first thing I want you to hear. The second thing is, there is an income phase out. So this begins to phase out at $500,000 of income, and it's fully phased out at $600,000 of income. And it reverts back to 10,000 cap. So if you're over 600,000 of income, nothing is changing for you.
Wow.
Right? Nothing.
Yep.
The other interesting thing about this, which I find fascinating, and I would love to know why they did it, but I don't think anyone there is going to talk to me about this. The phase out of 500 to 600 is exactly the same for individuals as it is for single taxpayers as married, which makes the marriage penalty argument come back. I mean, there are
lots of penalties. You mean this one is part of the.
It might be
a
deal breaker for us, Matt. This might be like.
I know. We were doing this mostly for the deduction.
Mostly.
It's part of our vows. Might have been part of our vows.
We were pretty much teetering.
For better, for worse, as long as we get twice the deduction.
Marriage neutrality.
Yeah. Well, we'll look at that
out there because and it does make for those of you that have flow through entities, a lot of the states, when this happened with the SALT, they created this pass-through entity tax, which meant your partnership or your S corp could pay tax at the state level. That business could deduct the taxes, and then so you got the benefit of it through your business. So that's still in play as an avenue for people to use too.
I'm trying to toggle. Frankly, I was so captivated by the SALT conversation. I got distracted. Distracted. All right. So
let's get back on track.
Let's refocus. Okay. Mortgage interest deduction.
Nothing changed. So if you remember back in 2016, until the TCJA, you could deduct interest on up to $1 million of debt plus $100,000 of equity. The Tax Cut Jobs Act said we are going to cap that at $750,000, and that is staying where it is. So no changes there. So that's, again, some stability. There is a new limitation for total itemized deductions. It's a very small little caveat. I'll mention it just so you're aware of it. But if you're in the very top bracket, the 37% bracket, the maximum deduction percentage you can get for your itemized deductions is 35%. So that's not a worry that anybody should have unless they're sitting in the top bracket. Charitable.
Did you say that when you were talking about the mortgage interest deduction, right? That's I assume that's a 2026. I mean, unless you specifically described it, these are next year provisions.
Unless I say it's 2025,
right,
which I did with the SALT, it's a 2026 effective. But in the mortgage interest case, it's nothing is changing from Tax Cut and Jobs Act, so it's just continuing on. Yeah. And I think they made that one permanent. I think that was a permanent made. Permanent. Charitable had a lot of changes, which I find interesting. Charitable and savings, I always find interesting in the government. Like, I would think you would want to incentivize charitable giving and saving money like no other part of the tax code. But so they started junking around with the charitable. Charitable's always had a ceiling. All right. So in taxes, a lot of these things, when you hear the term floor or you hear the term ceiling, a floor means you have to get over some hurdle in order to deduct something. So medical is the classic. You have to get over a 7.5% of your adjusted gross income floor. And once you do, you get every dollar over it. You don't get the dollars up to it, but you get to deduct the dollars over. Charitable works in the reverse. There's a ceiling. So you get every dollar up to a ceiling. So in the past, years ago, it was always 50% of your adjusted gross income. You could take a cash donation. You could get, it was 30% if you were donating appreciated assets like stock or a mutual fund. Tax Cut and Jobs Act, I'm a little fuzzy on this. I think in the early days of that one, it took the cash ceiling to 100%. I can't remember what year that was. It was for a year or two, you could do 100%. And then it dropped to 60. And this OBBBA has locked in the 60. So you can deduct up to 60% of your AGI as a charitable contribution.
For cash.
Cash, thank you, cash. What it also did is it put in a floor. So now charitable has a floor and a ceiling. And its floor is 0.5% of your AGI. So you got to get over a little floor, and then you got a little ceiling. So you got you got to stay in between those. Another caveat with the charitable is, like the itemized deductions, if you're in the 37% bracket, the maximum benefit you can see is a 35% tax savings. Does that blow your mind? Did you have to think about it for a second?
What a strange,
it's just the weirdest rule. They were just
that's an interesting
around with it. And I'm
rule.
like,
it's pretty niche.
It's so niche. Way more bougie. Niche.
I say niche, but I'm just a
you're not bougie.
Bumpkin.
No one has ever accused you of being bougie.
No.
But the thing I do love they did, and I think this happened in one of the Obama bills, they're giving some deduction above the line to non-itemizers. So if you're single and you don't itemize, you can take $1,000 above, and I say above the line, I'm throwing some tax lingo at you guys so you can look super cool at your next cocktail party.
Oh yeah, nothing cool than talking taxes at your cocktail party. Trust me. Right. Oh yeah, super cool. Flock away from me. All right.
Above, when I say the line is adjusted gross income. So typically it's your gross income less above the line deductions gets you to your adjusted gross income. And then from there, you deduct either your standard deduction or your itemized deductions to get you to your taxable income. So the above the line means you don't have to itemize to take this. And so it's $1,000 for single taxpayers, and I think it's $2,000. It's double. There's no marriage penalty. It's double for married, filing, joint. So lots of little new rules with charitable.
Yep. Yeah.
And I give a nod to Obama because I think in one of his bills they did this, and it was really popular, and then it went away, and so I was glad to see that it got brought back.
Yeah.
Social Security. You clearly have been waiting to talk about this.
I mean, you're close.
Right.
You're close.
So I still have people ask me, is Social Security not taxed now? And I'm here to tell everyone, nothing about the taxation of Social Security benefits has been changed.
I mean, that's not really a totally true statement, right?
It is 100% a true statement.
But there's a however. There's a however. Am I wrong?
Social Security benefits under $32,000, if you're joint filing joint, up to $32,000. It's a three-tier situation. It's 0, 50, and 85. If your joint income is under $32,000, then they do not tax any of your Social Security benefits.
Okay.
That's how it's always been. Between like 30, and this is joint. Between like $32,000, I think it's $44,000, 50%. of your Social Security benefits are taxed. And then everybody else above 44,000, the maximum they tax your Social Security is 85%. Okay. So nobody picks, if you look at your return carefully on the form, it'll show your total benefits. And then in the line that totals up your actual income, it'll always be 85 or less, depending on if your income's less. I would say what the administration hung their hat on as fulfilling that campaign promise, because it was a big one, is that they did this new senior deduction. And it's an addition to, if you're over 65, you get an additional standard deduction for just being over 65.
Period. And separate from this.
And separate and blind. If you're over 65 or you're blind, in addition to your major, main standard deduction, you get an additional amount. And I'm sorry, I don't know that number off the top of my head. It's like a couple $1,000s.
Yeah.
It's not like a double amount.
Right. Okay. Yeah.
Yeah. Just to put it in like perspective. So this is an above the line deduction, meaning you don't have to itemize to get the new senior tax deduction. It is $6,000 per taxpayer who is over the age of 65. So 66 or older. If you have a married filing joint, you're both 66 or older, that's a $12,000 deduction for you. But it's got a phase out in a pretty low range. I think it begins to phase out at 150,000 for married filing joint, and it's completely phased out at 250. So, depending on your income, you may or may not get it.
Right.
Which is why I say most people's Social Security is still going to be taxed exactly the same way as it always was.
Right. Fair enough.
Interestingly, this phase out is also not tax neutral. It starts marriage neutral. The phase out for singles, so if you're a single person over 65, you get a $6,000 possible deduction because it's per taxpayer. Right. Your phase out begins at 75,000, so half of the married, but it's fully phased out at 175, which is not half of 250, right? So again, some weird
typo.
No,
is it possible? No, not typo.
I mean, there were years ago where like getting the tax code as marriage neutral as possible was like this big push, and I felt like they had gotten there. So it was just kind of weird to see some of these like quirky little things come
and odd, yeah.
What's left of my slide? Throw me my slide. I can't remember what's.
Oh, you can't see your slide? All right, yeah.
I just need to see it real quick.
All right, yeah, no problem. I'll leave it up. I want people to be engaged. All right, here we go.
I think I had another.
Charitable income tax deduction.
Charitable, yeah, we already did that. Good, nice job. So the Trump savings accounts. I put this up here is just because it's my lead into a little bit of a gripe. So when you talk about complex versus simple tax policy, right? There's some things that make a good tax policy, and making it as simple as possible so you have higher compliance and you're not wasting IRS resources on going after people who don't, or having a hard time doing it. Right? Simple is usually better. And I think there's no better example of that complex versus simple than the savings account world in the U.S. There are over like 15 types of retirement accounts. They all have different eligibility rules. They have different contribution limits. They have different phase outs. If you're in a plan, can you do it? It is so complex. And so, I mean, so what my opinion is, I think it disincentivizes savings.
You think the complexity?
Yes, because people are like, forget it. I don't want to get in trouble. Forget it. It's just too much of a pain. And, now you got HSAs and you got education savings accounts and there's just so many. And so I would have liked, no one called me unless they were spam and I just didn't answer the phone because I get so many a day.
Missed out.
It's possible that was it. But I really wish that this bill would have just had like a universal savings account that could have just addressed this issue instead of doing what they did, which is adding just another savings vehicle.
Right.
Which is the Trump savings account.
Right.
I like the concept of the Trump savings account because it's a way for you to save for your children without them having earned income.
Right.
The clients are like, I got to put my kid on the payroll so I can do a Roth. Okay. This
legally.
We all know. We all know what we're doing.
All right. I'm just disclaiming.
We all know what we're doing.
I'm the host. That's my job. Am I the host?
Yeah.
I'm the host, right? Okay.
But I'm saying this is a great way, and they're sweetening the pot by saying if you have a kid in the next few years, we'll put $1,000 to jumpstart your account. But it's really for anybody who has a kid under 18, they want to start putting some money away. That I like. Encouraging savings, even from a young age, I think is a good lesson. So that part I like, but I really wish that they had just taken the opportunity to simplify the whole world of savings.
Yeah. Well, and it is. I mean, to your point, a lot of our planning work is around, retirement accounts, obviously,
Right.
charitable giving, obviously,
Right.
and tax planning is all kind of a part of that. And it is the complication, that I would say the pros of a Roth, whether it's a Roth IRA, a Roth 401k, whatever it is, the pros are significant. That's been around a while, right? And they've
I
changed,
agree.
the rules a little bit, et cetera. But there are some cons, and the cons are the complication of earned income, and
Well, and they've made some changes. I mean, when they took for Roth conversions, when they got rid of the income,
yes,
remember back in the day, if you had more than 100,000 of
you,
income, you couldn't convert to a Roth, and so
that's
that's when
right,
everybody started doing the workaround where they put money into the traditional IRA and just roll it.
right,
And once they got rid of that, people just started rolling Roths, and I think it's a great thing. I see so
yeah,
much Roth activity
yeah, yeah,
in 403bs. I mean, even at the company level, people
yep,
really
right.
take advantage of a Roth.
Yeah, the amount of clients that we have now that when they retire, they've got a Roth component. They've got a Roth 401k or Roth, right? There's a Roth
Yeah,
element to it, which is meaningful. I mean, from a planning standpoint, it's fantastic, right? The RMD is obviously, it's a requirement to the name, and
yep,
but once we're in the world of the Roth, now we've got assets that we don't have to distribute.
right.
I mean, it's great from an inheritance standpoint.
When people ask me, like, should I convert to Roth? I mean, the first question I usually ask is, do you plan on using this IRA money to live on?
Right.
And if they're like, no, I have plenty of other assets I'm going to live on, I'm going to take this because I'm forced to. I'm like, well, let's talk about a conversion,
Yeah.
And come up with a plan to just slowly drip it, and you pay the tax, but you don't want to blow up your tax rate. You don't want to jump to the highest bracket, but kind of smoothing it out over a set of
Yeah.
years to get
Yep.
some money over.
Yep. I agree. In some ways, that's a natural segue into talking about what we're doing, but about the last kind of slide and the impacts that all of these can have, right? In terms of investment, and then in terms of how investment impacts a tax return. And here, let me go to my slide. I only get one slide. I feel like is that a
You're not as important as
representation of?
me. You're not. You're
That's
not.
and I gotta be more. I gotta be mindful of time. All right, let me. All right. For anybody who is only half listening, I'm going to give you a heads up. Shelby's part is behind us. All right, so now you can dive in. Now you can dive in. I
Now
mean,
you can turn it off. You can move on.
I
You can
include
start your day
myself in
now.
that. I include myself in that. Or yeah, actually, the reverse may have just happened. We could watch people drop off. Like, I don't have any interest in what we're talking about. But and again, I mean, this is about the OBBA, but there are implications that will impact the market, and there are and frankly, some of those are around individual tax, but not. I mean, really only on the consumer spending front, right? I mean, if we think that Americans, generally speaking, are going to have kind of more money, more to keep at the end of their tax return, then or if there are incentives that incentivize spending, that is net positive. And of course, from a market standpoint, you've now got the economic value of consumers spending money, putting money back into the market, right? The multiplicative effect of spending,
Right.
which I think, frankly, our country's proven is certainly possible. Spend you got to spend it to
I
make
know.
it,
There's no problem there.
as a client of mine used to say. You got to spend it to make it, which I love. But so this focus is really around basically the budget and kind of policy driven components of the act, right? So and a few of these are relatively straightforward. I mean, I don't hit on this on the slide, but it's kind of an overarching point, which is this act is I mean it's the impact on the budget is that we're still going to run a deficit, right? And
Correct.
a meaningful deficit. And I mean, we've been running deficits for quite a while. I guess we've gotten used to it. And I will say, I'll remind everybody that this is my compliance person, that everything I say is just Matt Pohlman's opinion. But Actually, it isn't just Matt Pullman's been a lot of a lot of folks who are. I mean, you could go online right now, and it's a long list of longtime investors who believe that running a deficit year after year after year, which obviously results in debt, right? We still have to we still have to kind of balance, things. We got to pay people, and results in debt, and increased amount of debt is then kind of circles back to the budget, because now we've added to our national debt, and the addition to the national debt is going to carry an interest payment.
Right.
And if there's more debt and more interest, then that's more that we've got to pay for in our budget. It is to say it's a vicious cycle is not, doesn't even really describe it well. It's significant. So it is important to think about all of this in the context of a a budget, a meaningful budget deficit, and increased debt. So, but the policy elements here are, you've got an absolute. I think, Shelby, I think you might have even touched on this briefly, but we've got defense spending, and I'll touch on that a little more in a second. But I should have air quoted defense. I'm not sure why I air quoted new in that first slide. The energy, new energy. So in this case, the beneficiaries of this bill are those who are the incentives have shifted, right? With their incentives for incentives that existed in the past, some of them have gone away, and so they have gone, it's shifted, but they've gone away, and new ones have come into place, and the new ones are pushing for energy. The new incentives are around building out the infrastructure for the kind of energy complex, which is frankly I make a very good argument that that's defense related. In fact, to that point, yesterday there's a company called Lithium Americas Corp, and basically the United States government said, "All right, we're going to own 10% of this company. It's a lithium miner," and so because we believe that access to lithium is a national security issue, and I frankly think they're probably right, but there are lots of those, and so where you fall in terms of the viewpoint on how involved the government should be in the private sector, the view is that we have to. There is a national security element to, or just a national functional element to, for example, having an operating electricity grid, and so you've got industries that are going to get the tailwind of the government kind of pushing us to say we need to improve this, and generally speaking, that means meaningful capital expenditures, right? And meaningful capital expenditures generally that's a rising tide that's going to raise a bunch of ships. It's not just the concrete and steel people. It's a home run for them. It's a ton of ancillary industries. There are a ton of kind of not even just ancillary, but so many people benefit, whether it's from kind of where you are along the kind of process of building out infrastructure, or really any capex project. And actually, this is a tax element too. When taxes are kind of known, when the tax law is known, you can make it stable. Thank you, stable. You make decisions. Right, it's one of the beeves with the kind of tariff rollout is, well, wait a minute, what are the tariffs actually going to be? Are they going to, right? And so and it's a fair beef, right? So we don't know where they're going to land, and so it's very difficult to make decisions. Well, guess what? If you're not sure how the world's going to look, it's hard to make a multi-year decision if you don't know how the next 6 months look, if it could be meaningfully different. And
and I think which is why it was so important that they created some other stability with locking in what people had been used to for 8 years, right? So that was like the dance they were trying to make. They knew they were going to have some kind of big changes that people were going to kind of shock them a little bit. So they had to have some stability somewhere.
Yeah.
And I think that's what they tried to do with extending most of that TCJA.
Yeah. I think that's true. I think most of the kind of corporate community looked at this and says, okay, if nothing else, this is an act of kind of getting everybody on the same page. We can all read out of this, right? Whether you,
because that got more shook up than the individual side. I don't
For
even know
sure it
much about
did.
the corporate side, but that
Oh no,
side got
absolutely.
way more shook up with
Yeah.
this bill than the individual side.
In fact, one of the that's almost a segue. It's almost like you were trying to be
Oh,
helpful.
I
Almost.
was not trying to be helpful to you.
Defense and R&D support. R&D. I mean, research and development has got there's now meaningful like tax favored treatment for R&D
Yeah.
expense.
Yeah.
Across, and that's
And it's made
research and
permanent, and
development.
they made it permanent.
Yeah, I mean, I really actually think this is a big shift. This is research and development across all sorts of sectors. I mean, it is a defense spending is not just Boeing and Lockheed Martin and whomever. It's artificial intelligence. There are elements of our electricity grid. I mean, so defense spending and R&D support is huge, a huge needle move. And I think generally speaking, most investors look to that point as that's got a growth orientation for the economy and kind of therefore for the market. Mm-hmm. And I think that's a reasonable point. There are sectors that are going to be winners and losers, and I think also, I mean, you think about, so you've got increased defense spending, right? And I know that's not an individual tax topic, but it's broad and it's a big number. So I mean it's because it's got growth. It does have a growth orientation, right? Mm-hmm. It's right. Dollars getting kind of pushed in there, and I would already kind of put policy elements to that, but whatever. But it's already having an impact. I mean, there are already kind of winners and losers in that world, and winners and losers is, frankly, that's a healthy market. I mean, winners and losers means mentality. By the way, I mean, winners and losers sounds in today's world.
Yeah.
Can I even say the word loser? Winners and non-winners.
Oh, that's better. That's better. That's better.
Winners. There are going to be winners and non-winners, but that increases volatility. And volatility is it's investing, right? Without volatility, you really don't have an investment, right? Or at least, I mean, maybe even treasuries are experiencing volatility, and I'll have to touch on that here, even though I'm being mindful of our time and a couple of questions have come in. But so if you've got winners and losers, you've got, in fact, I believe, I don't know what the market's doing right now, but right before I jumped onto the webinar, I read that. So right now, the Dow Jones, NASDAQ, and the S&P 500 are both down on the day. Not a lot, but all three of those are down. I might be the only person on this call that finds this interesting, but it's crazy to me. March was the last time that those three indices were all down on the same day. It might even be that they all moved in the same direction on the same day, all green or all red, and that, which I don't think is right. I think
so that's unusual, I guess.
So the implication, it is unusual, but the implication is that means things are moving in, right? That means NASDAQ's up, Dow's down. It means Dow's up, NASDAQ's down. S&P 500's up, and the Dow's down. And I mean, that's winners and losers. In some ways, I can't. I mean, that's healthy. That is healthy. When the whole market moves together, that's I don't believe, generally speaking,
it's so much of like a herd mentality. Is that
there is that.
It's just a reactionary, like when it's moving together.
Of course. Yeah. I mean, for companies, the top companies. I mean, if you're looking at semiconductor companies, or I mean, just as an example, because they are, I mean, there are at least two of them. I mean, chip makers are a meaningful part now of the S&P 500. It's like, okay, well, if they're crushing it, does that necessarily mean that the utilities are crushing it? I mean, right. Those shouldn't necessarily correlate, but more often than not, they're correlating now these days. That's partially due to dynamics of how people invest and whatever. That's webinar number 2. That's webinar 2, where I have an actual expert with me. Well, I'll see if I can find
Oh,
come on, relax. That's not true. Shelby's an expert, even though I'm not supposed to use that terminology. You are an expert. But anyhow, so you've got all of this, right? So you've got all of this volatility, which is great, which is, I think, generally good for investing. And maybe I'm forcing this part of the conversation, but it's so natural. High volatility in the markets at a time when, even per Jerome Powell, markets may or may not be pricey. I mean, that's just opinion. And if markets are expensive and treasuries are paying low treasury rates, right? So you've got your risk-free assets are paying very, very low. and the risky assets are, let's just at least make an argument that there's a premium for those. You've got this huge gap, and it opens up the opportunity. I mean, you fill the gap by saying, oh, wait a minute. There are options, pun entirely intended, to handle that, right? You can take on less risk than the broad market, right? If you let's just take a covered call strategy as an example, and I really do believe this is absolutely a critical element. There no longer is an option strategy this kind of behind the scenes voodoo, right? It's not like, oh my God, don't say options in public, right? It's absolutely commonplace, and frankly, it should be commonplace. But the point is that the options can be used to dampen volatility. So instead of taking on all the risk of an expensive market, you can use options to take on to still be in the market and basically trade away some of the upside. Gotcha. And for that, you get defense, right? Instead of going up it basically just dampens the volatility. The peak and the trough of the waves, right? It feels kind of like trigonometry-ish, but it's certainly that is what it does, right? And you can even use options to be even more defensive, right? You can take basically a long position that says, I believe that the market is overpriced and it's going to go down, and at a time when treasuries aren't. We were getting. I mean, you probably saw us on tax returns back in 23.
All of a sudden, I saw nothing but accrued market discount interest from all the treasuries on everyone's 1099s. Makes
perfect sense.
30 years, I was like, I've never seen across the board. It didn't matter who the investment firm was. Everyone had all of a sudden treasuries everywhere.
That's right. Because if you're getting paid 5.5% for a risk-free asset, I mean, and that is generally what it means. It's in the investment world, it's the risk-free asset. That's pretty good return over a long period of time. Well, now it's 3.5% or 4%. Right. So you start to think, am I willing to take that little return? So it's just classic kind of market dynamics, right? And so this actually gets to the point of we're going to have shifts, or we're going to have shifts on this front, and they're going to be winners and losers, which is great. That's what we want, and we just need to be aware of where the incentives are, right? So reshoring, domestic supply chain. We've got all of the kind of broad kind of industry that is around AI, but you could argue, semiconductors, cybersecurity, that's all similar. And by the way, we need to provide the energy for all those. So we've got nuclear energy that's now getting some more love, etc. It really, the bill has really shifted things. Not kind of forever or it's very dramatically, but there's a clear shift, or at least there are incentives that are shifting kind of who the winners and losers are, and there are dollars going to it, budget shifts, and we still have tariffs outstanding, and so at some point, we will have some, and we already have some more certainty around tariffs, but so all of that to say, and now I'm being mindful of my time. I'm being we're 54 minutes in. Some of us are 54 minutes in. That is, I write a weekly whiteboard, so I address some of these. So anything that I haven't covered later. And actually, I know we have two questions here. So let me and we may have more. I can only see these two. All right. So this feels like a Shelby, which is great.
Oh, okay. Later on.
It says, based on the new bill, how do you see using stock gifts, IRA, RMD giving, and cash to make the most impact on charitable giving?
Oh, okay. Interesting question. Yeah. So remember I talked about the ceilings, right? So I see clients do everything. I see them donate from their IRA to a charity, which is great. I see lots of appreciated stock being donated, and I see people using DAFs and those kind of things too. I see less cash than I used to. What?
DAF seems like from a planning standpoint in our world, it seems like a real opportunity to control both giving, but also timing. from a timing
Well, if you
standpoint.
have a year where you have just a lot of income and you've got some charitable giving upcoming,
Yeah.
then you can front end load, which is great. And then you can kind of control that you just front end loaded and got the deduction all in one year,
Yep.
right?
Yep.
So especially if you're in a really high bracket. Now, the little teeny thing they did making it so that the maximum you can get in charitable is a 35% savings, even if you're in the 37% bracket, it's 2%. I mean, a lot of people aren't going to lose a ton of sleep over that, but I do have a one client in particular they are very generous, and the income limit starts to pose issues for us, because if you give in excess of your ceiling, and I'll make this quick because I know, Matt, you want me to keep this under. If you give in excess of your ceiling, you can carry it forward, but only for 5 years. So
Right.
if you're going to be charitable every year, you kind of start to build up this weird carry forward. What you don't want is to lose it. And you get
Right.
5 years out and you're like, oh man, I never actually got the tax benefit of that. So we use a good combination of, even though she needs her, her RMD for something else, like we will still use the RMD for gifting, or not the RMD, but the IRA for gifting,
Right.
because you can give up to, I think it's $104,000 from your IRA to a charity in 2005, and it jumps up to maybe 114. But because that doesn't have a ceiling, it just has
Right.
that cap, right? So
Right.
then you can give that way, and then still have some charitable needs that you can take it with your cash. So you can just kind of mix and match so it works, so you get the most deduction as soon as possible.
This is the most shameless plug I think I can. I mean, although based on this next question that I'm pumped about, I'm going to have two shameless plugs. There is, whether it's Shelby in East Franklin Capital or whomever it is, this is actually the advantage. There is real advantage to having a real conversation back and forth between what's happening in the investment accounts and tax planning, and it happens around charitable giving for sure. Right.
For
there
sure.
is, it's what are the right assets? What accounts are they coming from? I mean, the amount of tax savings, not just the kind of positives that happen from giving, but the tax savings can be significant just in planning around that.
Well, and two things. I got to be careful doing that. Remember, the balloons come up when I do that.
I know, you better hurry. We only have 2 minutes left.
Okay. So I was going to say, no, you want to do your thing. You talk about yours.
Well, we have another question. One, it's awesome. Matt, I know you mentioned options. I've always thought options were tax inefficient. Is that true? And if so, how does that impact what you've described?
Because there's short-term gains.
Oh my gosh, 2 minutes. This is an entire webinar. This is literally an entire.
This is webinar 2.
No one will show up to it, but the short answer is this. So in a world, especially in a world where returns can be muted, right? So whether it's a fixed income or even the long market, I mean, at some point we've had, it's had a heck of, but it's at some point if returns are muted. So let's say in a tax efficient investment, we're not talking about the vehicle, right? So if it happens in an IRA, this doesn't matter.
And nobody cares. Okay, yeah, right. I got it.
But so if we're talking about something that'll be taxed if you can pick up, let's say you have an investment that's tax efficient, extremely tax efficient, right? And so you're making 5%, and you're only paying whatever. A small, a preferred rate.
Okay.
Yeah. And so you're getting 4, or you're making 6 and getting 5.
Preferred rate, you mean it's a long-term gain?
It's a long-term gain, right? So because even in non-options, if it's short-term, it's still
non-options. Short-term is ordinary income, correct?
So let's say that a covered call strategy where the call income that we're generating, which could be 8 to 10%, right? You say, well, 8 to 10%. Okay, well, let's say it's 9, right, the middle of that. Well, even if that's tax inefficient, that 9 may be 6. Well, 6 is better than 4,
right?
Right. So my answer, is
the option.
Net return is what matters. It's a little bit like the broad investment concept of risk-adjusted return. If you're getting this much more return for this much more risk,
right? That's no good.
That's not ideal, right? And so in this construct, it's like, okay, well, yes, they can be more tax inefficient, but if the final return number is higher,
I could not agree more.
Right? Confound turn. I mean, so why do you care? If someone says, look, you don't have to see how the sausage gets made, you're going to get 6% return versus 4% return, right? After tax. All right, it's exactly 3. so thank you, Shelby. I
You're
will say,
welcome.
and this feels but I mean, I really appreciate that you've done this, and I know
You're
I kind
welcome.
of Cal and I had a kind of strong arm into it, but I really appreciate it. I do think it's helpful, right? We
I'm
just
kind of
passed
a
a
behind the
meaningful
scenes
bill.
girl, so you made me
You
get
are.
out in the front.
It
So
it is it right. I'm usually the eye candy. I get it. But
that's
it
not what I
is
meant.
this is a significant bill, right? It's got a
Yeah.
lot of implications. You don't
Yep.
pass major bills all the time, and so
No.
I
And
thought
there's
we
way
should.
more in it than we discussed,
That's
even on the
right.
individual side.
And so to that end, I mean, to everybody on this call, to everybody, all the one person on this call. No, there are lots on this call. I really do appreciate it. I know Shelby does too. I appreciate your attention, and you've given us an hour of your time. If you have additional questions or want to dive deeper on any topic, let me know. I'll probably have a follow up to folks. But this has been. I hope it's been helpful to you. It's been fun to kind of think about, and thank you for joining us. All
Yep.
right, enjoy the rest
Thanks.
of your day.